Before we dive in, please remember that this video is for informational and educational purposes only. I am not a financial advisor, and the information presented here should not be taken as financial, legal, or tax advice. Always consult with a qualified professional before making any major financial decisions. Your financial situation is unique, and this presentation is not a substitute for personalized professional guidance. You found it, the perfect home. It's not a sprawling mansion, but it's yours. A beautiful manufactured home in a quiet community, a stylish tiny house on wheels that screams freedom, maybe even a houseboat gently rocking on the water. The price is right, your down payment is saved, and you're ready to finally escape the soul-crushing cycle of renting. You walk into the bank, filled with hope, you lay out your plans, and the loan officer gives you a sympathetic smile before crushing your dream. They tell you they can't give you a traditional mortgage. Why? Because your home isn't considered real property. It's a gut punch. It feels like a door has been slammed shut in your face. You're left wondering, is that it? Is the dream over before it even began? How can a home not be real? Well, what if I told you there's another door? A side entrance that millions of Americans have used to bypass the traditional system and buy the home of their dreams. What if I told you there's a type of loan specifically designed for this exact situation? A financial tool that most people have never even heard of, but one that could be the key that unlocks everything for you. It's called a chattel mortgage. And if you've ever felt stuck, confused, or rejected by the traditional housing market, then this might be the most important financial term you learn all year. In this video, we are going to pull back the curtain on the chattel mortgage. We're not just going to define it, we're going to demystify it completely. We'll break down exactly what it is, how it's different from a regular mortgage, and most importantly, how you can use it to secure financing for homes that the big banks often won't touch. By the time you're done watching, you will have a crystal clear understanding of this powerful alternative. You'll know the pros, you'll be aware of the cons, and you'll be able to spot the critical red flags. You'll be equipped with the knowledge to decide if a chattel mortgage is the right move for you, and to approach lenders with the confidence of someone who truly knows their stuff. This is the guide you need to turn that no from the bank into a yes on your own terms. So, let's start with that bizarre-sounding word. Chattel. Sounds like something out of an old Western movie, and honestly it kind of is. The word chattel is ancient. It's directly related to the word cattle. Hundreds of years ago, a person's wealth wasn't measured by stocks or a 401k. It was measured by their tangible, movable property. Their most valuable movable property? Their livestock. Their cattle. So, chattel came to mean any piece of personal property that you own that isn't land. It's the stuff you can pick up and move. Your car is chattel. The furniture in your house is chattel. Your laptop, your television, a boat, a piece of farm equipment, all of it is chattel. It's your personal movable stuff. This is the absolute most important concept to grasp, because it's the polar opposite of what the traditional housing market is built on, which is real property. Real property, or real estate, is the land and everything permanently affixed to it. The dirt itself, the concrete foundation poured into that dirt, the house built on that foundation, the in-ground swimming pool, the driveway. You can't just pick up your driveway and move it to another state. It's part of the land. It's real. This distinction is everything. It is the entire reason the chattel mortgage exists. A traditional mortgage is a loan secured by real property. You borrow hundreds of thousands of dollars and you tell the bank, if I fail to pay you back, you have the legal right to take my real property, my house and the land it sits on, to cover your loss. The land is a huge part of the collateral. Stable, it usually appreciates in value and it's not going anywhere. But what happens when the home you want to buy isn't permanently attached to land that you own? What about that brand new double-wide manufactured home that's going to be placed on a rented lot in a park? What about that tiny home built on a trailer chassis with wheels? What about that incredible houseboat moored at a marina? In all of these cases, you're buying the structure, but you don't own the land underneath it. From a bank's perspective, this is a huge problem. They can't use the land as collateral, so a traditional mortgage, a real property loan, is completely off the table. This is the gap where so many people's dreams fall through. And this is precisely where the chattel mortgage steps in to save the day. A chattel mortgage is a loan secured by a piece of personal property, by chattel. The loan is tied only to the movable object itself, not to any land. It functions on the exact same legal and financial principles as a loan for any other major piece of personal property. To make this incredibly simple, just think about a car loan. If you've ever financed a car, You already understand 90% of how a chattel mortgage works. When you get a car loan, what's the collateral? It's the car itself. The bank gives you money, and in return they place a lien on the car's title. You get to drive it and use it as your own, but they technically have a claim to it until the loan is paid off. If you stop making payments, the bank doesn't come after your house or your land. They come and repossess the car. They take back the specific piece of chattel that secured the loan. A chattel mortgage for a home works in the exact same way. The loan is for the physical home structure itself. The manufactured home, the tiny home, the houseboat, that is the collateral. The lender places a lien on the home's title, just like a car title. If you default on the loan, the lender can repossess the home, but they have no claim on the land it sits on, especially if you're just renting that land. This is why it's the perfect, and often the only financing solution for these types of properties. The process is often faster than a traditional mortgage, with less paperwork, because it's not tied up in complex land deeds, titles, and zoning laws. It's a straightforward loan for a piece of high-value personal property. So let's recap the core idea. A traditional mortgage is a real estate loan, secured by a house and the land it's permanently attached to. A chattel mortgage is a personal property loan secured only by the home structure itself, and it works just like a car loan. Now that we know what it is, the billion-dollar question becomes, is it actually a good deal? Is it the right choice for you? Because while this type of loan can be an absolute lifesaver that gets you into a home you couldn't otherwise afford, it also comes with a completely different set of rules, interest rates, and potential pitfalls that you absolutely need to know about before you even think about signing on the dotted line. Let's break down who this loan is really designed for, and the crucial differences you'll find when you start comparing it to the traditional mortgage you hear about on the news. First off, let's get straight to the point. A chattel mortgage isn't for everyone. It's a specialized tool for a specific job. If you're looking to buy a traditional stick-built house cemented onto a foundation in a suburban cul-de-sac, you can probably stop watching right now. This isn't for you. But if you're part of a growing number of Americans exploring alternative paths to homeownership, then you need to lean in close. The number one audience for a chattel mortgage by a long shot is the manufactured home buyer. We're talking about homes built in a factory and then transported to a site. This is their bread and butter. Why? Because often, these homes are placed on land that the owner doesn't actually own. They might be leasing a plot in a manufactured home community, or placing the home on a family member's land. In these cases, you can't get a traditional mortgage because a traditional mortgage requires you to own both the structure and the land it sits on. A chattel loan brilliantly sidesteps this by only focusing on the home itself. The second group is the tiny home community. As this movement has exploded in popularity, so has the need for flexible financing. Many tiny homes are on wheels designed to be mobile. They are, by definition, not permanently affixed to land. A chattel loan treats the tiny home just like what it legally is in many states. Personal property, similar to an RV. It provides a path to financing that simply wouldn't exist in the traditional mortgage world. And that brings us to the third group. Owners of high-end recreational vehicles, houseboats, and even some modular homes. If it's a dwelling, but it's not considered real property in the eyes of the law, a chattel mortgage is often the go-to solution. Think of it as the financial bridge for anything that blurs the line between a vehicle and a house. Finally, there's a less common but important use: commercial financing. Small business owners looking to finance heavy, movable equipment, like a bulldozer for a construction company or a mobile food truck, might also use a form of chattel mortgage. The principle is the same. The loan is secured by the valuable, movable asset itself, not by any land. So, what is the fundamental magic that makes this loan work for a factory-built home but not a house in the suburbs? It all boils down to a few critical, game-changing differences when you compare it to a traditional home loan. And understanding these isn't just academic. It will directly impact your wallet, your timeline, and your rights as a homeowner. The first and most important difference is the collateral. That's the fancy banking word for the thing the lender can take if you stop making payments. With a traditional mortgage, the collateral is the real property. This is a legal term that means the house itself, and the plot of land it is permanently attached to. They are legally fused together. Think of it like this: you're not just buying the house, you're buying a specific chunk of the planet Earth that the house happens to be sitting on. The lender's security is in both the physical structure and the dirt underneath it. You can't separate them. If you default, they take the whole package: the house, the yard, the driveway, everything. Now flip that coin over. With a chattel mortgage, the collateral is only the personal property. In this case, that's the home itself. The structure. The manufactured home, the tiny home, the houseboat. The land is a completely separate issue. The loan is secured by the title to the home, much like a car loan is secured by the title to your vehicle. This is the key that unlocks everything. It's why you can get a chattel mortgage for a home you plan to put on rented land. The lender doesn't care about the land, because they have no legal claim to it. Their security is in the physical asset, the home, which they could, in a worst-case scenario, repossess and move. This single distinction is the foundation for every other difference between these two loans. The second major difference is the closing process, and for anyone who's ever bought a traditional house, this is a big one. A traditional mortgage closing is a marathon. It's a mountain of paperwork. You have property surveys to confirm boundary lines, title searches to make sure no one else has a claim to your land, and a formal appraisal process that can take weeks. The entire journey from application to getting the keys can easily stretch out for 30, 60, even 90 days. It's slow, it's complicated, and it's expensive, with closing costs often running into thousands of dollars. A chattel mortgage, on the other hand, is a sprint. Because the land isn't involved, you get to skip a huge amount of that red tape. There's no need for a land survey or a complex title search on the property. The process is streamlined to feel more like buying a car than buying a house. The paperwork is simpler, the underwriting is faster, and the time from application to closing can be a matter of weeks, sometimes even days. This speed and simplicity is a massive selling point for buyers who want to move quickly and avoid the headache of a traditional real estate closing. But that speed comes at a price, which leads us to the third crucial difference: the interest rates and loan terms. Let's be brutally honest here. You will almost always pay a higher interest rate on a chattel mortgage than you will on a traditional mortgage. And there's a simple reason for that: risk. From a lender's perspective, a traditional home on its own land is a very safe bet. The land itself holds value, and the entire property is likely to appreciate over time. It's a stable, immovable asset. A chattel asset, like a manufactured home, is riskier. First, it can be moved, which adds a layer of complexity for the lender. Second, and more importantly, manufactured homes have historically depreciated or lost value over time, much like a car. While modern manufactured homes hold their value far better than older models, the perception of depreciation risk still lingers in the financial world. To compensate for this higher risk, lenders charge a higher interest rate. We're not talking a small difference either. It could be a few percentage points higher, which adds up to tens of thousands of dollars over the life of the loan. Furthermore, the loan terms are often shorter. While the 30-year mortgage is the gold standard in traditional real estate, chattel loans typically have terms of 15, 20, or maybe 23 years. A shorter term means you pay the loan off faster and build equity quicker, which is great. But it also means your monthly payment will be higher than if you stretch the same loan amount over 30 years. The fourth and final key difference is all about flexibility and location. A traditional mortgage locks you into one specific spot on the map. The home and the land are one, and they aren't going anywhere. Your life is tied to that piece of property. A chattel mortgage offers a completely different kind of freedom. It finances the home as a separate entity, giving you choices. You can buy a home and place it on a lot you're renting in a community. You can place it on family-owned land without having to legally subdivide the property. And crucially, if your life changes, you get a new job, you want to be closer to family, or you just want a change of scenery, you have the option to move your entire home to a new location. This mobility, this decoupling of the house from the land, is a profound advantage that the traditional housing market simply cannot offer. So let's recap. We have the traditional mortgage, tied to the land, lower interest rates, longer terms, but a slow and complex process. And we have the chattel mortgage, independent of the land, faster and simpler, offering incredible flexibility, but with higher interest rates and shorter terms. It's a clear trade-off: speed and flexibility in exchange for a higher cost of borrowing. This brings up the million-dollar question: is that trade-off actually worth it? And more importantly, how do you avoid the hidden traps that can turn this dream of affordable, flexible homeownership into a financial nightmare? In the next part, we're going to pull back the curtain on the pros and the cons, giving you the unvarnished truth you won't hear from a loan officer who's just trying to make a sale. So let's get right into it. The sales pitch versus the reality. On one hand, you have the promise of a fast, simple path to owning your own home. On the other, a set of financial risks that can be devastating if you're not prepared. Let's start with the good stuff, the reasons why millions of Americans have chosen a chattel mortgage. We'll call this the dream. The number one advantage, the one that gets people to sign on the dotted line, is speed and simplicity. If you've ever gone through the process of getting a traditional mortgage, you know it can be a soul-crushing experience. You're buried under mountains of paperwork, tax returns, pay stubs, bank statements, letters of explanation for that $150 Venmo you sent your cousin 3 months ago. The underwriting process can feel like a full-body financial audit that drags on for weeks, sometimes months. It's a marathon of anxiety. A chattel loan, by comparison, is a sprint. Because the loan is secured only by the home itself, not the land, the paperwork is drastically reduced. The approval process is faster, the underwriting is less invasive, and the entire timeline from application to closing can be a matter of weeks, not months. For someone who needs to move quickly, maybe for a new job, a growing family, or simply to get out of a bad rental situation, this speed is more than a convenience. It's a lifeline. It's the difference between being in your new home by summer or by Christmas. The second big pro is the lower upfront cost. Getting into a traditional home requires a significant pile of cash. Lenders typically want a 20% down payment to avoid private mortgage insurance, or PMI. On a $300,000 home, that's $60,000. That's a massive barrier for most people. Chattel loans, however, are often much more accessible. Down payments can be as low as 5%, and for some government-backed programs, even lower. This means you can get your foot in the door of homeownership for a fraction of the upfront cash. It makes the dream feel attainable, not 10 years down the road, but right now. Then there's the flexibility. This is a unique feature that a traditional mortgage simply can't offer. Because the home is legally considered personal property, like an RV or a boat, you have the theoretical ability to move it. Now, let's be clear, moving a massive manufactured home is a complex and expensive undertaking, but the possibility exists. More practically, this flexibility allows you to place a home on land you don't own. This is huge for people who want to live in a manufactured home community or on a family member's property. A traditional mortgage lender won't touch that deal because they can't secure the land as collateral. A chattel loan is designed for exactly this scenario. It unlocks housing options that would otherwise be impossible. And finally, there are the closing costs. A traditional mortgage comes with a dizzying list of fees. Appraisal fees, title insurance, survey fees, loan origination fees. It can add thousands, even tens of thousands of dollars to your bill at the closing table. Chattel loan closings are generally much simpler and, therefore, cheaper. You're not dealing with real estate law in the same way, so many of those fees simply don't apply. This can save you a significant amount of money right at the very end of the process, when your bank account is already feeling the strain. So to recap the dream, it's faster, requires less cash upfront, offers unique flexibility, and has lower closing costs. It sounds like the perfect solution, right? A financial cheat code to bypass the headaches of the traditional housing market. Well, this is the part of the conversation where you need to lean in. This is the part the salesman might gloss over. Because for every one of those pros, there is a serious consequential con. Let's call this the reality check. The single biggest reality check is the interest rate. Chattel mortgages almost always have higher interest rates than traditional mortgages. We're not talking about a small difference. Can be 2, 3, even 5 percentage points higher. Why? It all comes down to risk for the lender. With a traditional mortgage, the bank has your house and your land as collateral. If you default, they can take both. That's a very secure position for them. With a chattel loan, they only have the house, an asset that can be moved, damaged, or can lose value. To compensate for that higher risk, they charge you a higher interest rate. Now, a few percentage points might not sound like a big deal, but let's run the numbers. Let's say you're borrowing $150,000. A 30-year traditional mortgage at 6% has a principal and interest payment of about $900 a month. A 20-year chattel loan for that same amount at 9% has a payment of about $1,350 a month. That's $450 more every single month. But it gets worse. Over the life of the loan, that 3% interest rate difference will cost you over $86,000 in extra interest payments. That's more than half the original loan amount, just vanished into thin air. It's the price you pay for speed and convenience. This brings us to the second con, shorter loan terms. While a 30-year term is the standard for a traditional mortgage, it's rare for a chattel loan. Most are for 15 or 20 years, maybe 25 if you're lucky. A shorter term means you pay the loan off faster, which is good in theory, but it also means your monthly payments are significantly higher. So you have a double whammy hitting your budget: a higher interest rate and a compressed payment schedule. This can put a tremendous strain on your monthly cash flow. But the most critical, most financially impactful con: the one that truly separates a chattel loan from a traditional mortgage, is the issue of depreciation versus appreciation. A traditional site-built home on a piece of land is an investment. Over time, thanks to inflation and the scarcity of land, its value generally goes up. It appreciates. This is how people build generational wealth. It's the cornerstone of the American dream. A home financed with a chattel loan often does the exact opposite. It depreciates. Just like a car, the moment you take ownership, it starts to lose value. Why? Because its value is divorced from the land. The home itself is a manufactured product that ages, while the land is the asset that typically grows in value. Without being permanently attached to and legally part of the land, the home is just a depreciating object. This means that while you are making those high monthly payments, the actual value of your asset could be going down. You're not building equity in the same way. You're just servicing a debt on an item that's worth less and less each year. This leads directly to the fourth con, the resale and refinancing nightmare. Imagine 5 years down the road you need to sell your home. Because it has depreciated, you might find that you owe more on the loan than the home is actually worth. This is called being underwater, and it's a financial trap. You can't sell without bringing thousands of dollars to the closing table just to pay off the bank. And what about refinancing to get a better interest rate? It's incredibly difficult. Lenders are very hesitant to refinance a loan on a depreciating asset, so you can get stuck with that high interest rate for the entire life of the loan with no escape route. Fast, simple, and flexible on the front end. Expensive, depreciating, and restrictive on the back end. But there's one more layer to this. There's the dream, there's the reality check, and then there's the ugly truth. And that's the difference between foreclosure and repossession. With a traditional mortgage, if you fall on hard times and miss payments, you enter a process called foreclosure. It's a heavily regulated, court-supervised legal process that can take many months, even years. It gives you time and specific legal rights to try and save your home. With a chattel loan, you're not facing foreclosure. You're facing repossession. Because the home is personal property, the process can be brutally fast and has far fewer consumer protections. In some states, it can be almost as quick as having a car repossessed. You miss a few payments and you could be facing an eviction notice and a crew showing up to haul your entire home away, leaving you with nothing. The speed and simplicity that was so appealing on the way in can become terrifyingly efficient on the way out. So you're standing at a crossroads. On one path, there's the quick and easy key to a new home, wrapped in the risks of high interest rates and a depreciating asset. On the other, a slower, more difficult path that might lead to long-term wealth and security. Which do you choose? But here's the thing. For some people, the chattel mortgage is absolutely the right choice. It's a financial tool that, when used correctly by the right person in the right situation, can be a lifesaver. The trick is knowing if you are one of those people. In the next part, we're going to break down the exact scenarios and the type of buyer for whom a chattel mortgage makes perfect sense, and for whom it's a one-way ticket to financial ruin. So let's draw that line in the sand. Who stands on the win side, and who's on the ruin side? This isn't about good people or bad people. It's about good situations and bad situations. Understanding which one you're in is the most important financial decision you might make all decade. Let's start with the ideal candidate. Who is the person that a chattel mortgage was practically designed for? I want you to meet profile number 1, the landowner. Imagine a couple, we'll call them Mark and Sarah. They spent years saving, not for a down payment on a house, but to buy a piece of land outright. Maybe they inherited it, or maybe they found a beautiful 5-acre plot in a rural county and paid cash. Now they own that land. It is theirs, free and clear. The problem? Building a traditional stick-built house on that land is astronomically expensive. We're talking construction loans, architects, contractors, permits, a $500,000 project before you even break ground. For Mark and Sarah, a chattel mortgage is a golden ticket. They can purchase a brand new, high-quality, multi-section manufactured home for, say, $150,000. They use a chattel loan to finance the structure only. Their land, which they already own, serves as the ultimate security, not just for the lender, but for their own peace of mind. Their monthly payment is only for the house itself. They aren't paying rent on the ground beneath their feet. Every payment they make builds equity in their home, while the land they own is likely appreciating in value. They have the stability of a traditional homeowner without the crippling cost of new construction. They are in complete control. This is the absolute textbook, best-case scenario for a chattel mortgage. If you own your own land, or are in a position to buy it, this type of loan can be a powerful and intelligent tool to build a life. Now let's look at a more modern profile. Profile number 2. The strategic community dweller. This is the person who is moving into a manufactured home community, a so-called mobile home park, but they are doing it with their eyes wide open. Let's call her Jessica. Jessica is a retired teacher on a fixed income. She sold her large family home and wants to downsize to something affordable, low maintenance, in a nice, well-managed 55-plus community. She isn't just looking at the shiny new homes. She's investigating the community itself like a detective. She gets copies of the park's financials. She reads the lot lease agreement not once, not twice, but 3 times, maybe even has a lawyer look at it. She's looking for clauses about how and when the lot rent can be increased. She talks to current residents, asking them about the management, maintenance, and any surprise fees. She researches the park's ownership group online to see if they have a reputation for buying up parks and aggressively hiking rents. Jessica understands the fundamental trade-off. She is buying the home but renting the land. She knows her home will likely depreciate, but she's calculated that the total cost, her chattel mortgage payment plus the lot rent, is significantly less than renting an apartment or owning a condo with high HOA fees. She's not buying it as an investment to flip. She's buying an affordable and comfortable lifestyle for her retirement years. She has a stable income, excellent credit, and a hefty emergency fund. For Jessica, the informed, diligent, and financially prepared buyer, a chattel mortgage in a land lease community can be a sensible solution. But there's a third profile, one that's becoming more common. Profile number 3. The high-end movable asset buyer. Think about the rise of the tiny home movement or luxury, full-time RV living. These aren't your grandpa's campers. We're talking about $100,000, custom-built homes on wheels, or $250,000 fifth wheels that are more luxurious than most apartments. The problem is, you can't get a traditional mortgage for one of these. It's not real estate, but an auto loan might not provide enough capital or a long enough term. Enter the chattel mortgage. It's perfectly suited to finance expensive, movable personal property that will be used as a primary residence. This person might be a remote worker who wants to live in a beautiful location for 2 years, then move their entire home to another state. They understand the asset will depreciate like a vehicle, but they value the unparalleled freedom and flexibility. They have a strong portable income and are financing a lifestyle choice, not just the place to live. The chattel mortgage is simply the financial instrument that makes this specific, non-traditional dream possible. So we have the landowner, the strategic community dweller, and the high-end movable asset buyer. If you fit neatly into one of those boxes, a chattel mortgage could be a fantastic tool for you. But now we have to talk about the other side. For every success story, there's a cautionary tale. And the people in these tales often start with the best of intentions, only to find themselves in a trap they can't escape. Meet profile number 1 on the do not proceed list. The financially stretched first-time buyer. This is the person who is most vulnerable and, tragically, the most common target for predatory chattel lending. Let's call him David. David is young, has a decent but not great job, and very little in savings. He's desperate to stop throwing money away on rent and own something of his own. A traditional mortgage is out of reach. Then he sees an ad. Own your own home for just $900 a month. He walks into a dealership, and they show him a beautiful new manufactured home. The sticker price seems impossibly low. The dealer connects him with a lender who specializes in chattel loans. Because David's credit is just okay and he has no down payment, the interest rate they offer is sky high, maybe 9, 10, even 12% or more. But they focus his attention on the low monthly payment. What they gloss over is the mandatory lot rent of $600 a month at the community where the home is located. Suddenly, his total housing cost isn't $900, it's $1,500. A year later, the park management raises the lot rent to $675. The year after that, it's $750. Meanwhile, his new home has depreciated by 20% the second he signed the papers. He's now paying over $1,650 a month for a home that's worth thousands less than what he owes on it. He's trapped. He can't afford to move the home. That costs $10,000 he doesn't have. He can't sell it because he's completely underwater on the loan. He's paying a mortgage-sized payment with none of the benefits of real estate ownership. This is the financial ruin we talked about. It's a fast track to poverty, not prosperity. Next up, profile number 2 to avoid. The fixer-upper gambler. This person sees an older, used manufactured home for sale for a bargain price, say $25,000. They think, I'm handy, I can fix it up and it'll be a great cheap place to live. They get a chattel loan for the purchase price. But what they don't realize is that older manufactured homes can be a Pandora's box of problems. The plumbing might be polybutylene pipes, a ticking time bomb for leaks. The roof might be near the end of its life. The subfloors could have water damage. They spend thousands of dollars on repairs, pouring money into an asset that is still depreciating. Unlike a traditional house where a new kitchen can add real value, the money spent on an old manufactured home is often just gone. The market value of the home is capped by its age and a general stigma. They end up with a loan payment for the initial purchase, plus the constant drain of expensive repairs, all while paying lot rent for the land underneath. They've essentially taken on all the liabilities of homeownership with almost none of the equity-building advantages. Finally, there's one more person who should run screaming from a chattel mortgage. Profile number 3. The short-term thinker. This is the person who says, "It's not forever. I'll just live here for 2 or 3 years, save up, and then sell it to buy a real house." This is a catastrophic misunderstanding of the market. The first few years of ownership are when a manufactured home, like a new car, depreciates the fastest. After just 3 years, that $80,000 home might only be worth $55,000 on the open market. But due to the way loans are amortized, the owner might still owe $75,000. They are $20,000 underwater. To sell, they would need to bring 20 grand in cash to the closing table just to pay off their loan. Who can do that? Nobody. And the pool of buyers is small. The buyer needs to be approved by the park management to take over the lot lease, and they'll need to find their own financing, which can be tough for a used manufactured home. The idea of just selling it is a fantasy. For the short-term thinker, a chattel mortgage isn't a stepping stone. It's quicksand. So you have to ask yourself honestly, which profile are you? Are you the landowner, building a dream on a solid foundation? Or are you the stretched buyer, being lured in by a low monthly payment that hides a world of financial pain? Your answer to that question determines everything. And if you do see yourself in one of the positive profiles, the next logical question is, okay, how does this actually work? What are the steps to get one of these loans, and what do you need to watch out for? That process is a whole other journey, filled with its own unique challenges and pitfalls. Let's break down that journey step by step, not just as a list of instructions, but as a real-world gauntlet you have to run. To do this, let's imagine a buyer. We'll call her Jessica. Jessica found the perfect, brand-new manufactured home. It's a 3-bedroom, 2-bath model she wants to place on a plot of land her parents are gifting her. She's excited, she's ready, but she needs the financing. She needs a chattel mortgage. Her first step, and your first step, should not be the application itself. It's the pre-approval. Think of pre-approval as your ticket to the game. It's a lender taking a serious look at your finances, your income, your debt, your credit score, and giving you a conditional commitment for a loan up to a certain amount. This is not the same as a pre-qualification, which is often just a quick, informal estimate based on what you tell them. A pre-approval is much stronger. It means the lender has actually pulled your credit and verified your income. For Jessica, getting pre-approved for, say, $150,000 transforms her from a window shopper into a serious buyer. It gives her negotiating power with the dealership and a realistic budget to work with. Walking into a deal without a pre-approval is like going into a sword fight with a stick. You're just not prepared. So Jessica decides to get pre-approved. And this is where she hits her first major wall. A wall that trips up countless buyers. She walks into the giant, national bank she's used since she was a teenager. The one with the familiar logo and the ATMs everywhere. She explains she wants a loan for a manufactured home that won't be attached to land she owns. The loan officer looks at her, a bit confused, types a few things into their computer and says, "Sorry, we don't do that here." This is the critical secret of chattel lending. Most traditional mortgage lenders, the big household names, don't want to touch these loans. They're built for traditional real estate. So Jessica, feeling defeated, does what we all do. She goes to the internet. And she discovers the world of specialized lenders. These are the companies that live and breathe manufactured housing. Names like 21st Mortgage Corporation, Vanderbilt Mortgage, and others are the titans of this industry. They understand the product, they understand the process, and they understand the customer. Jessica also discovers that some local credit unions, especially in rural areas where manufactured housing is common, are fantastic resources. They often have more flexible terms and a personal touch the big guys can't match. Her search for a lender isn't just about finding someone who will say yes. It's about comparison shopping. She gets pre-approval offers from 3 different lenders. Lender A offers a decent rate but high fees. Lender B has a slightly higher rate, but almost no origination fees. Lender C is a local credit union that offers a great rate, but requires a larger down payment. Now she has options. She can weigh the pros and cons instead of just taking the first offer she gets. This is one of the most powerful positions you can be in as a buyer. With her best pre-approval in hand, Jessica officially starts the application. This is the part people dread, the paperwork. But it's best to think of this as assembling your arsenal. The lender is going to ask for a complete financial picture of your life, and the more organized you are, the smoother this goes. First, proof of income. This typically means your last 2 years of W-2s and your most recent 30 days of pay stubs. If you're self-employed like a freelancer or a small business owner, this gets more complicated. You'll need 2 years of complete tax returns, including all schedules, and likely a year-to-date profit and loss statement. The lender wants to see a stable, predictable flow of income. Next, your assets. They'll want your last 2 to 3 months of bank statements for all of your accounts, checking, savings, everything. And they will scrutinize these. Every single page. They're not just looking at your balance. They're looking for large, unusual deposits. A $50 birthday check from your grandma is fine. A sudden, unexplained $5,000 deposit is a massive red flag. If you got a cash gift from a relative for your down payment, you'll need a formal gift letter signed by them stating that the money is a gift and not a loan that you have to repay. Then your debts. The application will ask for a full list of all your debts. Car loans, student loans, credit card balances, personal loans. Be honest and be thorough because they are going to see all of it when they pull your full credit report anyway. Finally, information about the home itself. You'll need the purchase agreement from the dealer or seller, which details the exact make, model, year, and vehicle identification number, or VIN of the home. Yes, just like a car. Jessica gathers everything, a thick folder of her entire financial life, and submits it to the lender she chose. And now the waiting begins. Her application file is handed over to a mysterious, all-powerful figure, the underwriter. Underwriting is the black box of the lending world. It's where a human being, the underwriter, meticulously combs through every single document you provided to determine if you are an acceptable risk. They are financial detectives, and their job is to find any reason to say no. They're verifying your employment. They're calculating your debt-to-income ratio, or DTI. This is a huge one. Your DTI is all your monthly debt payments divided by your gross monthly income. For chattel mortgages, lenders typically want to see this ratio below 43 to 45%. If your DTI is too high, the alarm bells start ringing for the underwriter. They're also dissecting your credit report. They're looking past the 3-digit score and into the details. Do you have a history of late payments? Any collections or judgments? A bankruptcy in your past? 1 or 2 small medical collections might be overlooked, but a pattern of missed payments on a car loan is a serious problem. The underwriter is trying to build a story of your financial reliability. Every piece of paper you submitted is a chapter in that story. While Jessica is nervously waiting for the underwriter's verdict, the lender orders an appraisal and inspection of the manufactured home. This is another area where chattel loans differ from traditional mortgages. The appraiser isn't just determining the value. They are performing a detailed inspection to ensure the home meets all federal and lender-specific standards. For a new home like Jessica's, they verify the home's data plate, a metal plate or sticker, usually found in a kitchen cabinet or closet, that contains all the critical manufacturing information. It's the home's birth certificate. They ensure it was built to the federal HUD code. For a used home, the inspection is even more intense. They check the integrity of the frame, the roof, the axles, the floors. They're making sure the lender isn't about to finance a lemon. The value they assign is what the loan amount will be based on. If the home appraises for less than the sales price, Jessica would have to make up the difference out of pocket. Days turn into a week. The underwriter comes back with a question. They want a letter of explanation for a late credit card payment from 2 years ago. Jessica writes it up, explaining the situation honestly. They ask for an extra bank statement. She provides it immediately. This back and forth can be stressful, but it's a normal part of the process. And then she gets the call. Congratulations, you're clear to close. The underwriter has given their final approval. It's a huge moment of relief. The final step is the closing. This is where you sign the mountain of legal documents that finalize the loan. For a chattel mortgage, Two of the most important documents you'll sign are the promissory note and the security agreement. The promissory note is your official IOU, your promise to repay the loan under the specified terms. The security agreement is the document that pledges the home itself as collateral for the loan. This is the instrument that gives the lender the right to repossess the home if you fail to pay. You'll also pay your closing costs, which can include loan origination fees, appraisal fees, title fees, and the first year of your homeowner's insurance premium. Jessica signed the papers. The keys were in her hand. She had one, or so she thought, because getting the loan is just one part of the equation. The other, more permanent part? The interest rate. And the rates on chattel mortgages can hide some very expensive secrets. We're going to uncover those secrets and how to negotiate them next. The interest rate on your chattel mortgage is not just a number on a piece of paper. It's the single biggest factor that determines the total cost of your home over the next 10, 20, or even 30 years. It's the difference between building equity and opportunity, or being trapped in a cycle of expensive debt. Lenders count on you not understanding the nuances, the hidden levers, the secret triggers that push your rate up or down. But we're about to change that. First, let's address the elephant in the room. Why are chattel mortgage rates almost always higher than traditional mortgage rates? The answer boils down to one word: risk. From a lender's perspective, a traditional mortgage is secured by real property, land and a house that is permanently attached to it. That land is an anchor. It isn't going anywhere, and it generally appreciates in value. A chattel loan, on the other hand, is secured by personal property. Your manufactured home, as beautiful as it is, can technically be moved. It depreciates in value more like a vehicle than a site-built home. If you default, the process of repossessing and reselling a movable home is more complex and potentially less profitable for the lender. To compensate for this higher perceived risk, they charge higher interest rates. It's their insurance policy against potential loss. But that's just the baseline. The rate you are actually offered is intensely personal, and it's determined by a handful of critical factors you have a surprising amount of control over. The most powerful of these is your credit score. This 3-digit number is a summary of your financial history, and to a lender, it's a crystal ball that predicts how likely you are to pay them back. For chattel loans, the tiers are stark. Someone with a credit score over 760 is considered prime. They'll get the best advertised rates. Someone in the 680 to 759 range is still strong, but they might see their rate tick up by half a point or even a full percentage point. Drop into the 620 to 679 range, and now you're in subprime territory. The rates jump significantly. Below 620, getting a loan becomes very difficult and extremely expensive. Let's put that into perspective. Imagine a $100,000 loan. An excellent credit borrower might get a rate of 7.5%. A fair credit borrower might be offered 10.5%. That 3-point difference doesn't sound catastrophic, right? Wrong. Over a 20-year loan term, the borrower with the 7.5% rate will pay about $91,000 in total interest. The borrower with the 10.5% rate will pay a staggering $144,000 in interest. That's a $53,000 penalty for having a lower credit score. Your credit score isn't just a number. It's a $50,000 decision. The second major factor is your down payment. The more money you put down, the less risk the lender takes on. This is measured by something called the loan-to-value ratio, or LTV. If a home costs $100,000 and you put down $10,000, your loan is $90,000, giving you a 90% LTV. Lenders have magic thresholds for this. Putting down just 5 or 10% is common, but it keeps you in a higher risk, higher rate category. The magic number is often 20%. Crossing that 20% down payment threshold does two things. It significantly lowers the lender's risk, which can unlock a much better interest rate, and it often allows you to avoid paying for private mortgage insurance, or PMI, which can save you hundreds of dollars every month. A larger down payment is your way of telling the lender, I have serious skin in this game. I am invested in this property, and I am not going to walk away. They reward that commitment with a lower rate. The third key factor is the loan term, the length of time you have to pay back the loan. Chattel loans typically come in 15, 20, or sometimes 23-year terms. The trade-off here is simple. A longer term means a lower, more affordable monthly payment. But it almost always comes with a higher interest rate. Why? Because the longer the loan is outstanding, the more risk the lender is exposed to: risk of you defaulting, risk of interest rates changing, risk of the home's value depreciating further. Let's go back to our $100,000 loan at a 9% interest rate. On a 15-year term, your monthly payment would be about $1,014, and you'd pay a total of $82,000 in interest. Stretch that same loan out to a 23-year term, and your payment drops to a more manageable $899. But your total interest paid skyrockets to $148,000. You saved about $100 a month, but it cost you an extra $66,000 over the life of the loan. Choosing your loan term is a delicate balance between what you can afford monthly and what you're willing to pay in the long run. Now, beyond those big three, there are other more subtle factors at play. The age and condition of the manufactured home itself is a big one. A loan for a brand new, top-of-the-line home is seen as less risky than a loan for a 12-year-old home with visible wear. Lenders will absolutely adjust your rate based on the collateral they're securing. Where the home will be located also matters. A home being placed in a well-managed, reputable community is a safer bet for a lender than one being placed on a remote plot of undeveloped land. But the most important secret weapon you have is understanding that not all lenders are created equal. The financing offered by the dealer where you buy the home is often the most convenient, but it can also be the most expensive. They have established relationships and processes, but they may be marking up the rate to earn a commission. National banks, on the other hand, might offer competitive rates but have very strict, inflexible qualification criteria. And then there are local credit unions. They are often the hidden gems. Because they are member-owned and serve a specific community, they can sometimes offer more flexibility and more competitive rates than the big guys. This is where negotiation comes in. You do not have to accept the first rate you are offered. The single most powerful thing you can do is get pre-approved from at least 2 different lenders before you ever sign a purchase agreement. Get a pre-approval from your local credit union, and another from a reputable online lender specializing in manufactured homes. Now you walk into the dealership not as a supplicant asking for a loan, but as a savvy buyer with a firm offer in your back pocket. You can look the finance manager in the eye and say, "My credit union has already approved me for this loan at 8.2%. Can you beat that?" This completely changes the dynamic. You've created competition for your business, and that is the only way to ensure you get the best possible deal. When you get a loan offer, don't just look at the interest rate. Ask for a full loan estimate that breaks down all the fees. Lenders can sometimes advertise a seductively low rate, only to pack the loan with high origination fees, points, and other junk fees that drive up your total cost. Question every single line item. Ask what each fee is for and if it's negotiable. Many of them are. Finally, once you've found a rate and a lender you're happy with, ask about a rate lock. Interest rates can change daily. A rate lock is a guarantee from the lender that they will honor the quoted interest rate for a specific period, usually 30 to 60 days, giving you time to close the deal. In a rising rate environment, a rate lock can save you from a nasty last-minute surprise that increases your monthly payment for decades to come. Getting the right interest rate isn't about luck. It's about preparation, research, and negotiation. It's about understanding the game better than the person sitting across the desk from you. So you've done the work, you've shopped around, you've negotiated a fantastic rate, and you've got your financing locked in. You're ready, but now you're faced with the final boss. A stack of documents an inch thick, filled with dense legal jargon designed to confuse you. That's the closing process. And in the next part, we're going to demystify every single page so you know exactly what you're signing and what it means for your financial future. Okay, you're sitting at a table. In front of you is a stack of paper that looks like the manuscript for a novel you have absolutely no interest in reading. A person with a polite but firm smile slides it towards you, along with a pen. They say, "Just sign here, here, and initial here." The pressure is immense. You've come this far. You're tired. You just want the keys. This right here is the most dangerous moment in the entire home buying process, because that stack of paper isn't just paper. It's a series of legally binding contracts that will dictate a huge part of your financial life for the next 15, 20, maybe 30 years. And the lender is counting on you being too tired, too intimidated, or too excited to actually read it. We are not going to let that happen. Let's pull that stack apart, page by page, and shine a bright light on the 3 most critical documents you will ever sign. These are the big 3, the ones that hold all the power. Get these right and you're in control. Skim over them and you're giving that control away. First up, the heavyweight champion of the closing table, the promissory note. Don't let the simple name fool you. This isn't like an IOU you'd write to a friend. This is an ironclad, legally enforceable promise to pay back a very large sum of money. Think of it as the soul of your loan. It contains the 4 numbers that matter most. Number 1 is the principal amount. This is the big number, the total amount you are borrowing. Your first job at the closing table is to look at this number and make sure it matches exactly what you were told. No last-minute additions, no mysterious fees rolled in that you didn't agree to. If the price of the home was $100,000 and you put $10,000 down, that principal should be $90,000. Period. If it's $91,000, you stop everything and ask, what is this extra $1,000? Number 2 is the interest rate. We've talked about this, but on this document it's set in stone. This is the price you are paying to borrow the money. Is it the exact rate you locked in? Is it fixed as you were promised? Or is there some fine print about it being adjustable that you've never seen before? Verify it. This single percentage point is worth thousands, even tens of thousands of dollars over the life of the loan. Number 3 is the term. How long do you have to pay this back? 240 months? 360 months? This defines your monthly payment and the total interest you'll pay. Make sure it's the term you discussed. Sometimes, a lender might slip in a shorter term to make the loan look better on their books, which unexpectedly skyrockets your monthly payment. And number 4, the one everyone ignores until it's too late. The late fee clause. Every promissory note has one. It will spell out exactly how much you'll be penalized if you're even 1 day late, and what the grace period is. Is it a flat $50 fee? Is it 5% of the overdue payment? Know this number, because life happens, and knowing the penalty ahead of time is critical. So, the promissory note is your promise. It's simple, but it's absolute. Now for the second member of our big 3, the security agreement. If the promissory note is the soul of the loan, the security agreement is its teeth. Big sharp teeth. This is the document that officially makes this a chattel mortgage. This is the piece of paper that says your manufactured home itself is the collateral for the loan. It legally ties the property to the debt. Why is this so important? Because this document gives the lender the right to repossess your home if you default on the promissory note. It's the or else clause. You promise to pay in the note. The security agreement outlines what happens if you don't. It will describe the property in excruciating detail. The make, the model, the vehicle identification number or serial number. You need to make sure this description is perfect. A typo here can cause massive headaches down the road when you try to sell or refinance. But there's a hidden danger in some security agreements you need to look for. It's a clause called cross-collateralization. It's a nasty little trick. This clause might state that the loan is secured not just by the manufactured home, but by any other property you have with that lender. Let's say you have a savings account or a car loan with the same bank. A cross-collateralization clause could give them the right to seize funds from your account, or even claim an interest in your car if you default on your home loan. It's rare, but it's devastating. You need to scan that document for that phrase. If you see it, you question it, and you demand to know what it means for your other assets. The security agreement is what gives the lender their power. You need to understand the precise nature of that power before you grant it to them. Finally, we arrive at the third and final crucial document, the closing disclosure, or sometimes called a settlement statement. Think of this as the final receipt for the biggest purchase of your life. It is a 5-page document that itemizes every single dollar and cent involved in the transaction. All the money coming in, all the money going out. It's where everything comes together. Your mission with this document is to be a detective. The law says you're supposed to receive a copy of this at least 3 business days before closing. This is your study guide. The version you see at the closing table should be nearly identical. You're going to compare them line by line. Focus on the section called Closing Costs. This is where lenders can hide junk fees. You'll see charges for things like loan origination, appraisal, credit report, and title services. Many of these are legitimate, but you're looking for things that smell fishy. A $200 courier fee in an age of email? A $500 processing fee, on top of a $1,000 origination fee? These are often negotiable, but only if you spot them and question them before you sign. Then you'll flip to the page with the calculating cash to close table. This is the moment of truth. This is the final exact amount of money you need to bring to the table. It takes your down payment, subtracts any deposits you've already paid, adds in all those closing costs, and gives you a final number. Does this number match what you were expecting? If you were told you needed to bring $10,500, and this document says $12,000, you don't sign. You put the pen down and you say, "Please explain this discrepancy to me." Could be a simple mistake, or it could be a deliberate overcharge. You won't know unless you ask. The promissory note, the security agreement, and the closing disclosure. These are your holy trinity. Master them and you've mastered the closing. Now what about the other 20, 30, 40 pages in that stack? They're important too, but they're supporting actors. You'll see a truth in lending statement, which rehashes the loan costs. You'll see an application for the certificate of title, which is like the deed for your home. You'll see insurance documents, tax forms, and a dozen other disclosures. For these, your job is to scan for consistency. Does the interest rate on this page match the rate on the promissory note? Is your name spelled correctly on every single document? Is the property address right? You're looking for errors and contradictions. You have a right to take your time. You have a right to read every single word. You have a right to ask questions. The person across the table works for the title company or the lender. They are not your advocate. You are your own and only advocate in that room. Don't let anyone rush you. Don't be intimidated by the jargon. If you don't understand a term, you say, "I'm not familiar with that term. Can you please explain it to me in simple language?" Be polite, but be unmovable. This is your future on the line. You've done the hard work. You've found the home. You've secured the financing. You've navigated the inspections. This is the final step. By understanding these key documents, you're not just signing papers. You're taking command of the process. You're ensuring the deal you sign is the deal you were promised. So you review the documents. The numbers match. The terms are correct. You ask your final questions. And only then, with full knowledge and confidence, do you pick up that pen. You sign your name, and the keys to your new home are placed in your hand. It's an incredible feeling. But believe it or not, the deal isn't really done. The biggest challenges and the biggest opportunities are still ahead. You've signed the papers, you've got the keys. But what you do in the next 30 days can determine the next 20 years. The biggest mistakes aren't made at the closing table. They're made the month after. And we're going to cover exactly how to avoid them and how to start your journey of homeownership on the right foot. So let's talk about that first month. Think of it as the most important financial month of your life. The habits you build, the systems you create, and the mistakes you avoid in these first 30 days will set the entire tone for your homeownership journey. This is where the foundation for success is laid, or where cracks begin to form. The moment those keys are in your hand, the clock starts. Your first action before you even move in a single box is to do your own final walkthrough. I know you already did one. Do it again. This time, you're not looking to back out of the deal. You're looking to create a baseline. Take your phone and record a slow, detailed video of every single room. Narrate what you see. Open every window, turn on every faucet, flush every toilet, flick every light switch. Document the exact condition of the home on day 1, hour 1. Why? Because if something breaks on day 3, you want to know if that crack was already there or if it's a new problem. This video is your personal insurance policy, your point of reference for the future. Next, within that first week, you need to become the master of your mortgage payment. Do not wait for the first bill to arrive in the mail. Go online to your lender's portal or call them immediately. Your mission is to set up automatic payments. This is non-negotiable. In our busy lives, it is far too easy to forget a due date, and a single late payment on a new mortgage can be a devastating blow to your credit score. It signals to the entire financial world that you're already struggling. Set it up to be paid a few days before the actual due date, just to give yourself a buffer. But here's the pro tip. Set it and forget it is a trap. You set up the automatic payment, but you also set a monthly calendar reminder for yourself to log in and look at the statement. You want to see that the payment was applied correctly. You want to watch your principal balance slowly start to shrink. This keeps you engaged and in control. While you're setting up payments, your next call is to your insurance agent. You need to confirm with your own ears that your homeowner's policy, or your specific manufactured home policy, is active and fully in effect. Ask them to walk you through your coverage again. Ask them, if a storm tears the roof off tomorrow, what is my exact deductible? What is the process to file a claim? You don't want to be learning this during an emergency. Understand your policy when the stakes are low, so you can execute it flawlessly when the stakes are high. Now for a step that separates the amateurs from the pros. Create a home command center. This can be a physical binder or a dedicated folder on your cloud drive. In it, you will save a digital copy of every single document from your closing. Your loan agreement, the title, the bill of sale, everything. Then you'll add your insurance policy documents. You'll add the contact information for your lender and your insurance agent. As you buy new appliances or have work done, you'll add the warranties and receipts to this binder. This little bit of organization today will save you from catastrophic headaches later. Imagine 5 years from now your water heater fails. Instead of tearing your house apart looking for a warranty booklet, you just open your home command center, find the document, and see that it's still covered. That's a $1,000 problem solved in 5 minutes. With the systems in place, we have to talk about the budget, because the number your lender approved you for and the number you actually need to live comfortably in your home are two very different things. Your first full month's utility bills are going to be a shock. You've gone from an apartment where maybe some utilities were included to a larger space where you are responsible for everything: electricity, water, sewer, trash, and maybe gas or propane. Brace for impact. A smart move is to call the utility companies and ask for the average monthly bill for that address over the last year. It gives you a realistic target to budget for. And you must, starting from month 1, pay your maintenance fund. This isn't optional. It's a bill you pay to your future self. Doesn't have to be a huge amount. Even $50 or $100 a month, automatically transferred into a separate high-yield savings account labeled Home Repairs, makes a world of difference. A manufactured home, like any home, is a machine for living. And machines require maintenance. Parts wear out. Seals degrade. This fund is your shield against the tyranny of the unexpected repair bill. Without it, every leaky faucet becomes a financial crisis. With it, it's just an inconvenience. Now let's address a critical and often confusing piece of the chattel mortgage puzzle: the titling of your home. Unlike a traditional home, your manufactured home likely has a title, similar to a vehicle. Your lender will be listed as the lien holder on this title. It is absolutely essential that you follow up with your local Department of Motor Vehicles or equivalent county office within the first 30 to 60 days to ensure this process has been completed correctly. You need to verify that the title has been transferred to your name and that the lender's lien is properly recorded. A mistake here can cause massive problems years down the road when you try to sell or refinance. If you also own the land and your goal is to have the home legally affixed to the property to be considered real property, that's a separate legal process often called detitling. This process varies wildly by state and county. You need to be proactive. Call your county clerk's office. Ask them, "I just purchased a manufactured home on my own land. What is the exact process to have it legally affixed and surrender the title?" Getting this right in the first month is a power move that adds immense value and security to your investment. Finally, we have to talk about the most dangerous temptation you will face in your first month: lifestyle creep. You have a new home. It's exciting, and it feels empty. The old couch from your apartment looks shabby. The TV seems too small. The urge to go out and finance thousands of dollars in new furniture, electronics, and decorations is immense. Do not do it. This is a trap that has financially crippled countless new homeowners. Your first priority is to build your financial buffer, your emergency fund and your maintenance fund. Live with the old couch for a year. Save up cash for the new TV. Your home is a marathon, not a sprint. Going into debt for decorations in the first month is like sprinting the first mile of a marathon. You'll be exhausted and broke long before you reach the finish line. Get comfortable with your mortgage payment and new bills first. Understand your new financial reality. Let the dust settle. The furniture stores will still be there in a year, but your financial peace of mind, once lost, is much harder to get back. You've navigated the closing, you've survived the crucial first 30 days, and you've set up the systems for financial stability. You've successfully transitioned from buyer to owner. But ownership isn't the end goal. The real goal is freedom. It's about building equity, increasing the value of your asset, and using this home as a tool to build a better financial future. So how do you do that? How do you take this chattel mortgage with its potentially higher interest rate and turn it into a wealth-building machine? What if you could pay it off 5, 7, or even 10 years early, saving tens of thousands of dollars in interest without drastically changing your lifestyle? It's not a fantasy, it's a strategy, and it all comes down to understanding how to attack the principal balance of your loan. That is the secret key to unlocking real equity, and that's exactly where we're going next. Let's get tactical. Attacking the principal balance isn't about magic, it's about math. And it's a math that your lender is hoping you never do. Think of your loan as two separate buckets. You have the principal bucket, which is the actual amount of money you borrowed to buy your home. Then you have the interest bucket, which is the fee, the profit the lender charges you for the privilege of borrowing their money. Every single monthly payment you make is split. A portion goes into the principal bucket, and a portion goes into the interest bucket. Now, here's the devastating truth about the early years of your loan. Your payment is almost all interest. It's a waterfall of cash pouring into the lender's pocket. Only a tiny trickle is going toward your principal, toward what you actually owe on the home itself. It's why you can make payments for 5 years straight. Look at your statement and feel your stomach drop when you see that the total amount you owe has barely budged. You've been paying the lender's fee, not paying down your debt. Attacking the principal means you are consciously and deliberately forcing more of your money into the principal bucket, bypassing the interest bucket as much as legally possible. And when you shrink the principal, you shrink the amount of interest the bank can charge you on the next payment and the next and the next. It creates a snowball effect of savings that can literally change the entire trajectory of your financial life. So how do we do it? Let's talk about 3 powerful strategies, from easiest to most aggressive. Strategy number 1 is the set it and forget it method. Bi-weekly payments. It sounds simple, but its effect is profound. Instead of making one full mortgage payment each month, you pay half of your monthly payment every 2 weeks. If your payment is, say, $1,000 a month, you'd pay $500 every 2 weeks. You might think, what's the difference? It's the same amount of money. But it's not. There are 52 weeks in a year. By paying every 2 weeks, you end up making 26 half payments. That's the equivalent of 13 full monthly payments in a year. Instead of the standard 12, you've painlessly snuck in an entire extra mortgage payment without even feeling it. That one extra payment goes directly toward your principal. On a typical 20-year chattel mortgage of $80,000 at a 9% interest rate, that simple change alone could shave nearly 4 years off your loan and save you over $20,000 in interest. Think about that. $20,000. That's a new car. That's a college fund. That's 4 years of your life you get back free from that debt. Before you do this, you must call your lender. You need to ask them 2 questions. Do you offer a biweekly payment program? And is there a fee to enroll? Some lenders will administer this for you, sometimes for a small setup fee. Others won't, in which case you can set it up yourself through your own bank's bill pay system, but you have to be disciplined. Strategy number 2 is the roundup method. This is for everyone who thinks they don't have extra money to spare. Look at your monthly payment. Let's say it's an awkward number like $762.41. What if you just rounded it up to an even $800 every single month? That's an extra $37.59. It's the cost of a few fancy coffees or one large pizza. Feels like nothing, but that extra $37, applied directly to the principal every single month, can have a seismic impact. Over the life of that same 20-year loan, that tiny change could cut over 2 years off your term and save you more than $10,000. You're trading one pizza a month to save 10 grand and get out of debt 2 years early. It's the best trade you will ever make. You can take this even further. Find an extra $50, $100, or $200 a month. Cut a subscription, pack your lunch a few more times a week. Every single dollar you throw at the principal is a soldier fighting on the front lines for your financial freedom. Strategy number 3 is the lump sum strike. This is the knockout punch. This is what you do when you get a windfall of cash, a tax refund, a work bonus, a small inheritance. The temptation is to see that money as a fun fund. To buy a new TV, go on a vacation. And there's nothing wrong with that. But what if you saw it as a golden ticket? What if you took that $3,000 tax refund and made a single extra payment directly to your loan's principal? On that same $80,000 loan, a one-time $3,000 principal payment in your second year could save you over $7,000 in future interest payments and knock almost a full year off your loan. You turn $3,000 into $7,000. That's an investment return you won't find anywhere else on the planet, and it's a guaranteed return. The stock market can crash. Real estate can dip. But saving on guaranteed interest is always a win. Now, before you get excited and start sending your lender extra money, we need to talk about the 2 most critical warnings you will ever hear about this process. Ignoring this could mean all your hard work is for nothing. Warning number 1. Prepayment penalties. This is the lender's defensive shield. Some loans, especially chattel mortgages, have a clause buried deep in the fine print that says if you pay the loan off too early, you owe them a penalty fee. It's their way of clawing back the future interest payments they were counting on. They are literally penalizing you for being financially responsible. You must pull out your original loan documents and read them. Search for the words prepayment penalty. If you have one, you need to understand its terms. Often, it only applies for the first few years of the loan, or it might only trigger if you pay off more than 20% of the balance in a single year. You need to know the rules of the game before you can win it. If the penalty is severe, it may not be worth it to pay extra until that penalty period expires. Warning number 2, and this is arguably the most important. You must explicitly tell your lender where to apply the extra money. If you just send an extra $100 with your regular payment, most lenders will not automatically apply it to your principal. Instead, they will simply hold it and apply it to your next month's payment. They'll treat it as you just paying ahead. This does you almost no good. It doesn't reduce the principal balance, so it doesn't reduce the interest you're being charged. You are just giving them an interest-free loan. You have to be your own advocate. When you make an extra payment, you need to designate it for principal only. If you're paying by check, write for principal reduction only in the memo line. If you're paying online, look for a specific box or option to make an additional principal payment. If you can't find it, you need to call them. Make the payment over the phone and get verbal confirmation from the representative that the extra funds are being applied directly to the principal balance. Then, check your next statement like a hawk to make sure they did it correctly. You have to direct your money with the precision of a surgeon. Imagine you've done it. You've used these strategies. You've been rounding up, you've put your tax refund on the principal, and you've shaved 7 years off your loan. You've saved $30,000 in interest. You are just a few payments away from zeroing out that balance. The end is in sight. You are about to own your home free and clear. That final payment is a moment of pure triumph. But it's not the end of the story, because owning your home on paper and truly owning it in the eyes of the law are two different things. What happens after you send that final check? How do you get the title? How do you make sure the lien is removed and the property is legally, indisputably yours? And what if you want to sell? How does selling a manufactured home with a chattel mortgage differ from a traditional home? This final step, the endgame of chattel ownership, is a bureaucratic maze that can be confusing and costly if you don't know how to navigate it. You've fought the beast, you've conquered the debt. But what happens after the final payment is made? The process of actually getting your title and securing your freedom is a critical final step that most people get wrong. And that's the final piece of the puzzle we're unlocking next. When you send that final payment, a clock starts ticking. But it's not your clock, it's the lender's. By law, once your loan is satisfied, they are legally obligated to release their claim, their lien on your property. This isn't a courtesy, it's a requirement. The first thing you should expect to receive in the mail, typically within 30 to 60 days, is a critical document. It might be called a paid-in-full letter, a lien release, or a certificate of satisfaction. The name doesn't matter as much as its function. This piece of paper is the lender's official, legally binding declaration that you owe them nothing, and they no longer have any security interest in your home or vehicle. Do not throw this letter away. Do not file it and forget it. This is your first piece of evidence that you are free. But it's only the first piece. The next step depends entirely on your state's laws and how it handles titles. In some states, the lender has been physically holding your property's certificate of title since the day you signed the loan. Upon releasing the lien, they will sign the designated section on the title itself, officially removing their name, and then mail that original physical title directly to you. When that envelope arrives, it's like holding a key to your own kingdom. But increasingly, we live in a digital world, and many states now use an electronic lien and title system, or ELT. In an ELT state, there is no physical title being held in a vault somewhere. Instead, the lien is just a digital record in the state's Department of Motor Vehicles or equivalent agency's database. When you pay off the loan, the lender sends a secure electronic message to the DMV, instructing them to remove the lien from the record. Once the state processes this, one of two things will happen. Either the state will automatically print and mail a new, clean paper title to you, or you will be notified that the lien is released and you must formally request the paper title yourself, sometimes for a small fee. This is the first major pitfall where people stumble. They make the final payment, maybe they even get the paid-in-full letter, and they just assume the rest happens automatically. They assume the title is on its way or that the digital record is cleared. This is a dangerous assumption. Weeks can turn into months and months into years. You might not even realize there's a problem until you decide to sell your home or trade in your vehicle, only to discover the lender from a decade ago is still listed as a lien holder on the title. Now you're in a bureaucratic nightmare, trying to track down a loan number from a bank that may have been acquired twice over, dealing with departments that no longer exist, just to get a simple signature. So how do you avoid this? You become proactive. About 30 days after you receive that paid-in-full letter, you need to become a detective. Your mission is to verify. Call or go online to your state's DMV, BMV, or housing department, whoever issues titles for your type of property. Give them your vehicle identification number or hull identification number. Ask them a simple question. Can you confirm who is listed on the title for this property and if there are any active liens? Their answer is the ultimate source of truth. If they say your name is the only one on it and there are no liens, you have successfully crossed the finish line. If they say the lender is still listed, your work isn't done. This is when you get back on the phone with the lender's title department. Armed with your paid-in-full letter and the information from the DMV, you politely but firmly insist they complete their legal obligation to release the lien. Don't let them give you the runaround. Escalate to a manager if you have to. This is your right. The second critical mistake is mishandling the documents once you get them. When you finally hold that clean, clear title in your hands, a single piece of paper with your name on it and no one else's, it is one of the most valuable documents you will ever own. It is the physical embodiment of your ownership. Losing it can create a massive headache, requiring you to file for a duplicate title, which involves paperwork, fees, and waiting. You need to treat this document like cash or a passport. Store it in a fireproof safe, a safe deposit box, or with your other essential life documents. Make a digital copy but protect the original at all costs. And there's one final, often overlooked step in this process of untangling yourself from the lender: your insurance. For years, your insurance policy has listed your lender as a loss payee or additional insured. This meant that if your property was destroyed, the insurance check would go to the lender first to pay off your loan. Now that the loan is gone, they have no insurable interest. You need to call your insurance agent and have the lender's name formally removed from your policy. This cleans up your paperwork and ensures that in the event of a total loss, the full insurance payout comes directly to you, as it should. It's a final snip of the financial cord that connects you to the lender. And when all of that is done, when the lien is confirmed as released, the clean title is safely in your possession, and your insurance is updated, take a moment. Take a deep breath. What you're experiencing is the true meaning of ownership. It's a feeling of profound security and freedom. That home, that boat, that RV, it is no longer a shared asset with a financial institution. It is 100% yours. Every dollar of equity you've built, every improvement you've made, it all belongs to you. You can now sell it, gift it, or borrow against it on your own terms, without needing permission from anyone. This entire journey, from the first application to the final title, is what a chattel mortgage truly is. It's not just a loan type. It's a pathway. It's a tool that can open doors to homeownership and major purchases for people who might be locked out of the traditional mortgage market. But as we've seen, it's a path that demands your attention. It requires you to be more than just a borrower. It requires you to be a diligent, informed owner in training. You have to understand the unique nature of the interest rates and terms. You have to be aware of the depreciation risks and how to mitigate them. You have to navigate the complexities of property placement, insurance, and taxes. And as we just covered, you have to be the one who ensures that when the debt is paid, your ownership is legally and officially perfected. The power of a chattel mortgage lies in its accessibility, but its risk lies in the details. By understanding every step of this process, from the showroom floor to that final piece of mail from the DMV, you transform that risk into an opportunity. You take control of the process and ensure that this financial tool works for you, not against you. You've learned not just what a chattel mortgage is, but how to master it. If this guide has provided you with clarity and confidence, if it has demystified even one part of this complex topic for you, then do us a small favor and hit that like button. It tells the algorithm that this information is valuable and helps it reach others who need to hear it. And for more deep dives that break down the financial tools that shape our lives, make sure you subscribe and turn on notifications so you never miss an upload. Now I want to hear from you. What was the single most surprising thing you learned about chattel mortgages throughout this guide? Or if you've been through this process and paid one off, what did it feel like to finally get that clear title in your hands? Share your stories and your questions in the comments below. Let's learn from each other. Thank you for watching.